All right, let's jump right into this explainer. Today, we're putting on our detective hats and stepping into the shoes of professional equity analysts. Our mission? To uncover the true intrinsic value of ClearSecure, trading under the ticker UTL. You know the old saying, in the world of finance, market price is what you pay, but value is what you actually get. So, we're going to use real data from the company's own financial metrics to solve a very specific mystery. Is ClearSecure an undervalued hidden gem or just a dangerously overpriced hype stock?
We'll tackle this investigation methodically through 4 distinct valuation lenses: the mystery, absolute value, relative value, asset value, and then finally, we'll deliver our valuation verdict.
Part 1. The mystery. Let's start by investigating ClearSecure's current market price.
So, the stock is currently trading right at $56.23. At that share price, ClearSecure boasts a market cap of nearly $7.7 billion. For a company focused on biometric secure identity, yeah, that's a pretty substantial footprint. But as we know, a static price tag doesn't really tell us much without understanding the actual momentum behind it.
I mean, the trajectory here is just incredibly aggressive. ClearSecure has posted a year-to-date return of over 61%. Even more staggering, the trailing 12-month total return is almost 103%. That's insane. And this isn't just some one-year flash in the pan either. Their 3-year total return compound annual growth rate is nearly 34%. Now, when a stock literally doubles in a single year, professional analysts are forced to ask a really tough question. Is this exponential growth fundamentally justified by the underlying business operations, or are we looking at a stock severely overpriced by an overly euphoric market?
Part 2. Absolute value. Let's find the cash.
We're going to begin with the discounted cash flow model, or DCF. You can kind of think of the DCF as the absolute truth teller. It determines exactly what the business is worth today, based entirely on the free cash flow it's going to generate tomorrow. As an equity analyst, this is basically the gold standard evaluation because it totally bypasses market sentiment. Now, we could also look at the dividend discount model, or DDM, since ClearSecure does have a dividend yield of 1.07% with a 3-year growth rate of over 34%. But because they're retaining a massive chunk of their cash to fund aggressive growth, which we can see from a free cash flow payout ratio of just around 20%, the DCF based on total free cash flow is going to give us a much more robust intrinsic value. A residual income model could be another option actually, but given the lack of specific equity charge data in our source and the fact that they're a very asset-light company, the DCF really is our best bet here.
The mechanics of a DCF are actually pretty straightforward, even if the execution takes some seriously careful forecasting. Step 1. Project the firm's future free cash flows. Step 2 is to apply a discount rate, usually the company's weighted average cost of capital, or WACC, to account for the time value of money and, the inherent risk. And finally, step 3, you just sum it all up. Now, while our source data lacks the explicit WACC or terminal growth rate assumptions to show you the manual math step by step, it does provide the final mathematically modeled output.
And check this out. The explicit fair value price is $84.72, derived right from the free cash flow model. Keep in mind, the stock is currently trading at just $56.23. So this absolute valuation suggests the stock is actually significantly undervalued. Now, how is this possible? Well, it's highly driven by the company's incredible 3-year free cash flow compound annual growth rate of almost 36%. When a company grows its cash generation that rapidly, the compound effect in a DCF model creates a massive future valuation. Even if we assume a super conservative terminal growth rate, that sheer velocity of cash flow expansion pushes the intrinsic value way above the current trading price.
Part 3. Relative value. Let's compare the multiples and look at some peer pressure. Okay, let's break down the multiples the market is currently assigning to ClearSecure. We see a price-to-earnings, or PE ratio, of 50.21. Their enterprise value to EBITDA is 31.64, and their price-to-sales ratio sits at an elevated 8.54. Now, in traditional value investing, a PE ratio over 50 immediately suggests that the market is applying a very heavy premium to this stock. Think about it. You're essentially paying $50 for every $1 of current earnings. Since our raw source data lacks explicit direct competitor comparisons, as professional analysts, we have to apply a sensible industry default assumption to really make sense of this. ClearSecure basically operates as a high-growth tech and software as a service, or SaaS company. A typical healthy SaaS multiple in today's market might sit somewhere around a PE of 25 to 30. So, comparing ClearSecure's PE of 50 to that assumed industry baseline shows they are trading at a very steep relative premium. Relative to their peers, the stock looks, well, quite expensive.
But hold on, we can't just look at multiples in a vacuum. Paying that premium multiple might actually be entirely justified when you consider their absolutely staggering return on equity of over 61%, coupled with a really impressive return on invested capital of 17.25%. Management is just incredibly efficient at turning equity into profit. Plus, their PE of 50 is actually down from a 3-year average PE of over 77, so while it's definitely expensive relative to an average tech peer, it's ironically cheaper than it's historically been relative to itself.
Part 4. Asset value. Searching for the missing pieces. Now, we hit a bit of a snag in our detective work here. Our primary data source lacks the raw balance sheet line items, like exact cash reserves, property, or goodwill, that we'd need to calculate an exact, mathematically perfect per-share liquidation value, or net asset value. But we do have a massive clue. The price-to-book ratio is 42.15. If the stock price is $56.23, a PB of over 42 implies the actual hard net asset value per share is roughly a tiny $1.33. This tells us right off the bat that ClearSecure is a totally asset-light business. Its value is almost entirely wrapped up in its brand, its software, and its future growth, not in, physical real estate or heavy machinery. But hey, good analysts work with the clues they have to verify structural health. Just think about these figures: a debt-to-equity ratio of absolute zero. They also have perfectly matching current and quick ratios of 1.01, meaning they have just enough liquid assets to cover their immediate short-term liabilities without having to rely on inventory. This tells us this company is highly liquid and perfectly solvent, which serves as an excellent proxy for underlying asset health. Plus, a gross profit margin of almost 86% confirms our theory perfectly. This is an incredibly scalable, software-style operation that really doesn't require heavy capital asset investments to grow.
Part 5. The valuation verdict. Let's synthesize our models and bring it all together.
And honestly, this right here brilliantly illustrates the tension in professional valuation. Let's look at the breakdown. The absolute model, the DCF, is absolutely screaming that the stock is heavily undervalued at $84.72. But then the relative value model tells us it's priced at an expensive premium compared to industry peers with a PE over 50 times. And finally, the asset value tells us there's no real hard asset floor to fall back on, even though the balance sheet is completely debt-free and liquid. So the big question, which model do we actually trust? Well, for a high-growth, asset-light tech company like this, the DCF is generally the most reliable indicator of true intrinsic worth. That is, of course, provided those future cash flows actually materialize.
So the really crucial point here is the calculated margin of safety of 33.63%. Because the intrinsic value is $84.72 and the current price is $56.23, you essentially have a 33% discount. In the world of value investing, a margin of safety is basically your buffer against being wrong. Even if ClearSecure's unbelievable 36% free cash flow growth slows down a little bit, this massive cushion gives investors a really high degree of protection, all based on the firm's spectacular cash-generating abilities.
I want to leave you with this final thought as you evaluate this financial mystery for yourself. You have a rock-solid, debt-free balance sheet generating incredible free cash flow, pointing to an intrinsic value near $85. But to get a piece of it, you have to buy in at a steep relative premium today. So weighing that incredible $84.72 intrinsic cash value against those sky-high multiples, are you willing to pay up today for the safety of tomorrow's growth? It is the classic dilemma of the modern tech analyst. Thanks for joining me on this explainer, and as always, keep questioning the numbers.